Startup and organizational costs get special treatment only when you actually begin business. You can elect an immediate deduction up to $5,000, then amortize the rest over 180 months. But there's a trap. Once total costs go over $50,000, that $5,000 write-off gets reduced dollar for dollar. On the EA exam, they love the phase-out math and the month business begins detail. Here's the phase-out in plain English. If startup or organizational costs are $51,000, you're $1,000 over the threshold, so your immediate deduction drops from $5,000 to $4,000. The rest is amortized over 180 months. Also, if the business opens late in the year, you only get amortization for the months you're actually in business. That's why open November 1st means only 2 months of amortization. Now the fun part when plans change. If the taxpayer completely terminates the business before the 180 months are up, any remaining unamortized startup and organizational costs become deductible in that final year. Think of it as no more future benefit, so the IRS lets you take what's left. On the EA exam, watch for words like ceased operations or final return. Expansion is different from starting up. If a business is already operating and it adds a new location, new territory, or expands an existing site, those costs are generally ordinary and necessary business expenses. That means current deduction, not 180-month amortization. The exam tests this by giving you training, advertising, and pre-opening costs, but for a second location of an existing business. Failed startups are where people miss points. If you never actually create, start, or buy the business, your costs split into 2 buckets. Before you pick a specific target business, investigatory costs are personal and non-deductible. After you're in a bona fide attempt to buy or start a specific business, those costs are capital. For individuals, that usually means a capital loss on Schedule D, subject to the $3,000 annual net capital loss limit. Corporations get a friendlier rule here. If a corporation incurs costs trying to acquire or start a new business and the deal fails, it can generally deduct those investigatory costs as a business loss. So the same fact pattern can produce a capital loss for an individual, but an ordinary business loss for a corporation. On the EA exam, always ask, who is the taxpayer, individual or corporation? Cedar Ridge Partnership bought a rental duplex for $35,000. They added $10,000 of capital improvements and took $5,000 of depreciation. They sold it for $50,000 cash, plus property worth $10,000. The buyer paid $1,500 of real estate taxes and assumed an $8,500 mortgage. Cedar Ridge paid $2,000 in selling expenses. What is the partnership's taxable gain? Think about it. The answer is $28,000. First compute adjusted basis. $35,000 plus $10,000 improvements minus $5,000 depreciation equals $40,000. Then compute amount realized. $50,000 cash plus $10,000 property plus $8,500 mortgage assumed plus $1,500 taxes paid by buyer minus $2,000 selling expenses equals $68,000. Gain is $68,000 minus $40,000, or $28,000. A tempting wrong move is forgetting the assumed mortgage or the buyer paid taxes. Harborview Foods Corporation opened its doors on May 10, 2023. It incurred $53,000 of organizational costs in its first year. How should those costs be treated? The choices include a reduced current deduction with the rest amortized, a full $5,000 deduction, or no current deduction at all. Think about it. The correct answer is $2,000 can be deducted currently, and $51,000 is amortized over 180 months. A corporation can elect up to $5,000 of organizational costs, but that $5,000 is reduced dollar for dollar when total organizational costs exceed $50,000. Here, $53,000 is $3,000 over, so $5,000 minus $3,000 equals $2,000. The tempting wrong answer is taking the full $5,000 and ignoring the phase out.